Greetings, everybody. It's Jeff Scott, and this is my weekend review. Not exactly the way I planned it. I'm in Orange County at a George Lea meeting where I had the opportunity of speaking. I did this live. Frankly, it was probably one of the best ones I've ever done. I was told I was more animated. I guess it just means I'm dull otherwise. And Snagit, which is what I used to do the recording, kicked off, and I lost the first 45 minutes. So I'm starting over instead of going to dinner. It's approximately 7:12 out here in the Pacific area. And I think, as everybody knows by now, the future's opened up fairly strong. But what you also know is that hasn't meant anything over the last couple of weeks. I entitled today, Markets at Critical Levels. I think you know that too, and we'll talk about that and all the hype and things that are going on about the stock market. As always, this is for education purposes only. Any recommendations to make in the spirit of education, not investment advice. I'm a doctor, not a broker. Most physicians lose money with their investments. I'm not affiliated with any software vendor or trading company. Tools demonstrated are those that I use in my daily trading, and I paid for all the tools I demonstrate. Trading involves risk. You and you alone are solely responsible for any investment decisions you make. I did some education when I was out here, and I always like to talk about what I learned from Ian Woodward, and he taught me that his job was not to be a guru. His job was to teach me to be my own guru, and I like to follow on in his footsteps as much as possible. And my goal is to have you become your own guru, not just to do what I do. That's not, to me, the sustainable and best way of doing things. I started with CanSlim, improved with Morales and Catcher. Ian took it to the computer and added high-octane fuel. Ron Brown went from the sitting near me in the audience to in front of me as a speaker and partner with Ian. This is George Lea, a good buddy from Canada who was the headliner for the conference that I'm at. Known George for a long time. He's just a great trader. Van Tharp, position size money management king. And then what really changed my life was, besides meeting Ian at an early point, was when I got to understand the words and wisdom of John Person, his indicators, his trading style, his management of a trade, and that really improved my trading abilities. I own a lot of software. It's not by a mistake that I typically turn off my background so you don't see all my programs. I need TradeStation or Thinkorswim. Genesis offers a lot of value to me, but mostly when I'm looking at shorter-term trading in futures. For stocks, I use HGSI for the offline and in and out of market analysis. EdgeRater is a tool that automates some of the things I do anyways in HGSI and used to require Excel spreadsheet macros and time. Yes, I believe in seasonality. I use a number of different programs, but technicals trump seasonality. No pun intended with the Trumpster. And I have all of them, and they all have their pros and cons, and I use a number of different websites. This is the website for HGSI, highgrowstock.com. I'm independent, and as I said before, I don't have any relationship with these guys or any other trading company. I point out that they come with a free 30-day trial without even asking for a credit card, and they have, under investing strategies, they have access to a number of movies that I've done, Ron Brown, Gil Morales, and others. So where are we? And I'm ignoring the futures. I know they're up, but it doesn't mean a thing. And we've been through time and time again where we look like we start off early, and before the morning gets here, the Trumpster tweets out something about a trade war, China or Amazon, and the market sells off. So, we talked a lot at the meeting about stage one, which is ambivalence. Stage two is when we start to mark up the price. Stage three, we get uncertainty. Stage four, fear. And then we start all over again. And it certainly has felt for a long time that we have moved beyond three and trying to start stage four. But the minute that happens, the minute we think that we're there, we take another leg up. The minute we think it's there, we take another leg up. So based upon that, we're there. We're in the circle right now. Is this the beginning of the end, or just the another pause before we refresh and go higher. So I look at this, I try to figure out where we are, and I change my approach based upon where we are in the market. So I've raised some cash, taken smaller positions, and I've sold premium. I look at a lot of different sectors, and I look at them multiple times during the day. You can't see it well here because I have to dummy down my resolution. But if I was to look at TradeStation, where you won't see enough of it because I have to dummy down my resolution, you get a sense of what I'm talking about. And it's changed now because the market's open. That's, so we're already seeing early trading with the market open, although there's not a lot of volume. So I ignore the colors right now. BlackRock has earnings coming, so that's interesting. But I look by industry group or by sector ETF, what are the components of that, and get a sense of what the market's doing. Now, when I have my full resolution, it looks like this, and I can look across multiple sectors. And when we ended Friday, clearly we had a very weak market. You all know that. If you're watching me, you probably lost money on Friday. Not that I give bad advice, but it was that kind of a day in the market. Now, I like to look at the major market indices to get a sense of what I think is going on. Yes, you're probably thinking I spend too much time, but hey, I'm a top-down investor. If I can't understand the market, I can't tell you what to do. So, ignoring the last bar, because that is the the pre-market over the weekend bar starting today at 6 Eastern. And looking previous to this, I'm just amazed at this as we've hit the 200-day simple moving average on the E-minis 1, 2, nearly 3, 4, 5, 6, 7, 8 times. And we haven't sustained and ended the day except once below. Now, I have to believe if that 200-day moving average is so strong that we can't penetrate it on this many attempts, maybe it holds. Maybe it holds. But then I look at the falling 17-day, which crossed below the 50, the falling 50, and perhaps the best thing that we can expect is to bounce around in between the 50 and the 200, and then maybe I should stay, or you should stay on the sidelines until it breaks above the 50 or breaks down below the 200. I think we got a range-bound market until it declares itself otherwise. It's nice to see a green piece there, but it's early. The NASDAQ looks similar, although it hasn't popped down to the 200-day moving average. And frankly, it hasn't yet taken out the prior lows of the early February pullback, but it's gotten very, very close. It looks similar overall to the E-minis. The Dow Jones, let's see what I got. The Dow Jones has, there we go, that's what I was trying to do. Is like the S&P 500 has popped against this 200-day moving average several times and has bounced up, and it actually looks a little bit better than the S&P. The Russell 2000, ditto. Let's see, what did I do there? This. So we see the Russell 2000. Just check this. 3 months, 1 day, 6 months, 1 day. There we go. And the same pattern stuck between the falling 17 and 50 and the 200. With the markets challenged, the VIX, ignore the last bar. The VIX looks like the 50-day moving average, which had been resistance for a long time, has now become support to the VIX. And that doesn't bode well for the market if the VIX is truly going to level off at a higher level. But that said, it's nothing compared to what it was in early February with the big market sell-off, and I think that's probably the date that killed the XIV and seriously damaged holders of SVXY. The dollar has sort of been going sideways now since early February in a trading range, but is clearly in a downtrend as evident by the fact that it's so far below the 200-day moving average. Kudlow's a strong dollar guy, so maybe that means the dollar is going to firm. A strong dollar is not necessarily good for our markets, certainly not for gold and other commodities. Just looking very quickly at the weekly charts, you can see pulling back, in this case, a 17 weekly, 17 weekly, 17 weekly, 17 weekly. You can see the VIX versus where it was, and then the dollar, which has been weak on the weekly as well. So that really tells you that we have a market that is definitely challenged, and would like to see it personally turn around and go back up, but it's a little bit early to get excited about the futures, although I do have to admit they're pretty strong right now, all things considered, especially the NASDAQ 100. So my view on the market here is we're really sitting at a danger zone, that if we were to break through this 200-day moving average, after so many times we've been knocking on it and it's held, boy, it may turn into fierce resistance. Let's just hope we don't find that out anytime soon. And then using my Genesis just to show you what I can do, I have 3 time frames on this chart: daily, weekly, monthly. The first column is the mini, then the NASDAQ, then the Russell, then the NYSE, and lastly the YM. So even though we've had nice run-ups, as you can see on the monthly, the weekly and daily are a mess, and we've actually developed on everything but the NASDAQ 100 a monthly sell signal, which doesn't occur very often. And you can see how this sell signal down, this buy signal here, really was a strong move. Now, what's underneath this market? What other things might I look at to get a sense of what's working, what's not working, and what the market's going to do? I believe that as long as interest rates stay above 3%, stay below 3%, that the market's probably okay. When it breaks above 4%, it's going to pressure the indexes. We can see that on the 10-year bond and on the 30-year bonds, interest rates fell this week. Falling rates are good for certain stocks. Rising rates are good for the banks. This probably explains some of the bank weakness that we saw this past week. What about the AD lines? You can't see it well, but I'll show you on the next slide. The AD lines actually are higher while the indexes fell on both the small stock or medium stocks and the large stocks. You can see here that the AD line on this weekly chart flipped up, while the multiple ETFs that I have here, the Qs, the Spiders, the IWN, and the transports flipped down. And on balance, bonds actually pulled back as well this week, but they had been moving back up. So AD line strong, markets getting weak. Will the AD line be a positive divergence, or as my buddy John Person likes to say, convergence is the right word, and pull this market higher, put a strike down on the bullish side? And then what about breadth? Stocks above the 200, stocks above the 40 have had minimal change over the week and are both sort of in the non-specific range where they're not at extremes. I need extremes to make a call. And if I look at the 3-month new high, new low ratio, and you can see it was very low, bounded back up, and then failed. We're at a point where we could reverse, and we've certainly reversed, which means the market goes higher. But this one here argues that there's still room for some further selling before we get to an obvious reversal area. So let me say that again. Nothing says we can't reverse from here. Nothing says that these futures can't hold and can't be real. But nothing here says we must reverse today. When I get down here, here, and even here, a reversal is pretty imminent. I look at the McClellan, I look for things like extremes, I look for divergences, I look for zero line rejects. I don't see any of that right now. I see coming off the extremes on the daily, on the summation index, the oscillator pulling back into zero, and on the weekly, similar pattern, not much to say on the McClellan. If I look at the buckets, again, this is another tool to look for extremes in the market. I take the S&P 1500, I run every stock through machine language, not manual, with a Bollinger Band, and then I look for 2 pieces of evidence. One, what percentage of the stocks in the S&P 1500 are below the midline of the Bollinger Bands? That's 72%. That is a bearish number, no shocker. And then how many stocks are trading below or above the Bollinger Band? Very few stocks are below. So like the new high, new low 13-week index, we have a bearish picture here, but not one that is so bearish that the markets are clearly at a reversal point. They can reverse, but they don't have to reverse. There's not been a Hindi in over a month on either the NASDAQ or the NYSE, and there's no surprise there because once you get the Hindi, you start to lose the new highs over 2% and eventually the new lows over 2%, and then you won't get a Hindi until you get back to an area of extreme. Market tone, interestingly, and put a strike in the bullish hat, Thursday was enough without any kahunas to move us to bullish here on the Ian indicator, so we are less bearish. That's good if you are long. And sector strength is also less bearish than it was, although it weakened a little bit Friday versus Thursday. So there's enough here of bullish signals that I wouldn't be surprised if the market trades here. But there's not a lot of an exaggerated move that says we're going to rebound on some of my other indicators. Now, kind of indicative of the market we're in, we have a number of surrogate indexes that we put together. This one was put together probably 3 years ago, 2 years ago, looking at the large cap canaries, the Facebook's et al.'s price line is now called bookings. And we created our own index knowing that when these rolled over, this would be very impactful and meaningful to the market. And you could see back in February, quickly got back above the 50-day moving average. And we're sort of living here in limbo between the 50 and 200, stuck below the 50. I think that's bearish. I look at the index I put together a year ago in June, which were leaders at the time, and it had a high close doji on Thursday and broke down on Friday with a 50-day moving average ice hole failure. Think about falling through the ice and not being able to get back above the ice. What happens to you? You die. So often when you have a market that can't get back above the major moving average, it goes down to a new low, which would correspond with about where that 200-day moving average is. So that is bearish. And then the most recent leaders index I put together, one that's probably the most important right now, is the melt-up leaders from January 21st. Here's a little bit of the background on them. This was not a buy list. It was more of an early warning list if the market turned over. And they, too, are sitting stuck between the 50 and the 200-day moving average with lots of bearish signs. So there are reasons to be concerned. And if the best of the best look like this, then what does your own portfolio look like? Now, it's important to know your news and your earnings dates. So I always go to Bloomberg. Here's the reference here to see what the news events are for this week. We have a number of Fed heads speaking. Robert Kaplan, on Friday, James Bullard, Eric Rosengren, Neil Kashkian are all speaking. We get the FOMC minutes come out on Wednesday. It'll be interesting to see if the Fed was talking 4 rate hikes or 3. That's probably a big idea. Some comments about inflation are coming. So there's a fair amount of news there that could cause issues. And remember what happens when the Fed head, Mr. Powell, speaks. The market always falls. So hopefully he'll turn that around. And we're now kicking off earnings with the next quarter's earnings with banks, with Bank of the Ozarks, JP Morgan, Wells Fargo, Citigroup, all reporting. That'll give us a sense of the health of the banks, Delta Airlines, Fastenal, and industrial stock. So a lot of different things coming out this week. Now, one of the things we talked about at the live meeting is what could turn this market around, what could lead to resumption of the bull. And I think the answer is simple. Very bullish earnings might make this market go back up. And would I expect bullish earnings here? Absolutely. I think about the fact that the tax cuts should help a lot of these companies, that the first report on the tax cuts was not very favorable. And they talked about it wasn't favorable because they were taking some write-downs on some of their overseas money, but there were a lot of bullish comments made. So if those tax cuts are truly indeed a positive for the market, as our president and others in his party would like us to believe, then maybe we're going to see some blowout earnings, and that will power the next wave up in the stock market. And for those of us that want to be bullish or still have some long positions, that will be very nice. Remember about the earnings, though, it's a judgment call. to hold stocks over earnings dates, and it's bad judgment to not know when your stock's earnings date is scheduled. All right, pause for 1 second. I recognize that we're now at 20 minutes and I haven't told you one stock to buy to make you rich tomorrow. Well, if that's what you're waiting for, don't stay, because I don't think we're going to have that answer for you. I think this, as a top-down investor, I firmly believe that it's the market that drives the performance on my trading as much as it is or more than how I pick stocks. And I think right now the market is critical. Let's talk about a bear market. Now, these slides are used. I was sent these, although these are the slide picks. I couldn't find the slide sent to me, from Jim Slack. He is a money manager extraordinaire in Montana. And what he's known for, he also has a newsletter called InvestTech. What he's known for is calling out the bear markets in advance. So I don't subscribe anymore because we didn't get a bear market for so long. I'm kind of wishing that I actually was subscribing right now, because I think that's the question. How much experience have you had trading a bear market? Here's a couple of bear market facts to remember. Again, investtech.com, that's his publication and some of his services. Very smart, great speaker. From market peak to market bottom with the S&P 500, these are the bears since the Great Depression. And you can see the median duration of a bear market is 16 months. So the market that was so difficult, 2007, 8, and early 9, had a duration that was average at 17 months. Look at the duration in the late 30s. How about bear market decline? Are you prepared for an average decline of 33.5% without including the 86% in 1929? How about the plus 50% in 1937 or the plus or minus 57% correction in 2007? These are real, and these have dramatic, long-lasting, and permanent effects on your market. If you lose your capital in a bear market, and then we get, as we saw in March of 2009, the mother of all bottoms, you have no cash to play. What a shame. So this is way out of date, okay? But the point is, Jim Slack uses a number of characteristics. I can't tell you what confirmed bear market leadership is. They didn't really tell us. And I can't tell you what bellwether stocks are, but I bet those might be the Apple, Google, Facebooks, and things like that. Is there extreme optimism in the market here? Extreme optimism would be defined as the newspapers having something about the market going to 100 million tomorrow, your taxi and Uber driver trading stocks in between pickups and telling you what to trade. I would say that's a no. Ignore what's in this slide here. That would be a no. Is the money climate unfavorable? Yes, there's discussions of rising rates, but it's still pretty easy money. Rates are low, so I'm going to put a no. Do we have increased recession risk? Well, perhaps the trade war might raise fears of a slowing economy and a recession, but I'm hearing whether it's 2 or 3% is the question, not whether growth is 0. So that's a no. What about falling consumer confidence? We're at near record lows on the near record levels of the Michigan consumer sentiment. So that's a no. And then what about narrowing breadth? Breadth is increasing even though the indexes are falling. I put that together. I can't tell you anything about bellwether stocks or bear market leadership. I don't see bear market warning flags. That's critical because one of your jobs in managing your individual portfolio is the question of, is this a bear market or is this just a correction? And then you might decide to hold on a little bit longer. So these are from stockcharts.com. They were made today, so they're through today. And this is a band of moving averages between 100 and 290 by every 10. This is the S&P 500 on top and NYSE on the bottom. This is a weekly chart with weekly MAs. And I ask you a question. Are you bullish or bearish? And how does this market compare to recent peaks? So let's look at this pattern. We've got moving averages that are fairly well separated and in the original order with no crossovers. On the NYSE, there's a little bit, it's like we're coming back out and uncoiling, which is not necessarily bearish. So we've got the moving averages are laid up and the price is well above the moving average. Let's look at 96 to 2001. The market ran up for years above the upper moving average. Ultimately, it dived into the moving averages and ultimately below. Now, what happened from that, once this happened, we'll go back to this slide. What do you see? You see that breaking through the top of the bands led to a prolonged bear market that did not recover until May of 2003 when we broke above the bands. You see the bands rolling over, the guppy bands rolling over, but that's a late signal. So there's really three signals here. Signal number one is breaking into the bands. Signal two, to me, is breaking underneath the bands. And signal number three is the rollover of the moving averages. The first signal, the earliest, is going into the bands. And let's look at what this means going forward. 2006 to 2007, we had a beautiful run as we came out of that rough market. And a couple of times we pulled into the bands, but really didn't break it of any substance. This is the NYSE. Here's the S&P 500, where we didn't come close to breaking it during this period of time. And then what happened? Well, you know what happened. The market rolled over. We have the NYSE diving into the bands and coming out the bottom, and the S&P 500 doing the same. And you could see not once during this pullback did we actually pop back above the moving averages. And also, if I waited for those moving averages to roll over, then I would have been in late. So I'm going to be very sensitive to price going into the bands and wonder if there's anything else I can be doing that might confirm that. 2012 to 2016, another big run up in the market. And then at the end, we went into the bands, struggled around for a while, and never broke out the bottom on either the new NYSE or the S&P 500. Now, some folks think we've been in a bull market since 2009 or 2011. I really believe that this piece here in 2015 and early 16 was a significant correction that got to bear territory and resets the count on the bull market. So am I bullish or bearish here on April 8th? I'm well above the moving averages. The moving averages are lined up nicely. I'm going to say it's hard to be bearish. It's hard to believe we've got a bear market coming, and maybe this is just a run-of-the-mill correction. Now, I did find something else I can add, and it turns out that if I want to confirm a new buy or a sell signal, then what I look at is the MACD crossing above for a buy or below for a sell, the zero line. So not only are we way, this is today, this was when I calculated it a few weeks ago, we are way above the moving averages, and the MACD is on its way down, but to date it's nowhere close. I'm not giving up the thought that we're going higher here, but I'm also smart enough to raise cash, put on some protection, and let the market tell me what it's going to do. It's good to get an idea, but you can't just, forget about caution and cash preservation. So my thoughts, markets continue to pound against support. A decision point will eventually declare itself. The support hold and markets move to new highs, or will the 200-day simple moving average become resistance and lead to a larger sell-off? Hard to find leaders on my review as pressure to the downside is widespread. There was some movement in gold, but not much for flight to safety on the down days. And biotech was horribly weak. There was some very bad news from Insight on Friday or Thursday that took the market lower. I went through my typical stocks. I found few stocks at good buy points. There were some potential shorts. I'll call out at least one of them. And although many signals and many pundits say we're heading down again, my gut and my long-term indicators suggest that this is a correction and not the beginning of a new bear market. At least that'll hold until my next weekly look at the indicators I shared with you. Let's go into our top-down review. which will start with how I look in TradeStation with my John Person indicators as to what I think this market is doing, and is it a bullish or bearish market. Move this where it belongs, moves it right here. So those who've been here before, let me add a TF, know that I look at 6 points on every index. I look at it at least once a day, if not most days, and it gives me a sense of what the markets are doing. And that's important, because if I don't know what the markets are doing, then how am I going to trade and trade effectively? So let's start with the E-minis, and we see, well, they went blue, but I'm ignoring the last little bar because it's only a partial bar. But what we see is a buy signal on the E-minis, but a red bar on Friday. Red bars are bearish, and when I see a red bar, that's an Alexander Elder indicator. It says I can go short or hold. I shouldn't be entering new long positions. I'm red on the weekly. I'm in a buy on the daily, sell on the weekly, buy on the monthly. So a little schizophrenic market here, and will this weekly strength drive us to a weekly buy signal, or is this a retracement in a downtrend and we're going back down? Time will tell. I look at whether we're above or below the envelope, because I know when I'm below the envelope, there's often a snapback. I look for these red dots that are above, sometimes green dots below, which be evidence of negative or positive divergence, more evidence that the market might be reversing. I look at my high jump bar when it's above 95. I know I need to be careful. And I look at my weekly bongo when it's green, which is the middle of these three. I know we're in an uptrend. So as we've said today at our meeting, I would say this looks weak. It's not that exciting to the long side. And to get there, I'm going to have to see this go blue and then green. I'd like to see blue come on the weekly. I like to get rid of my weekly bongo. That's not going to happen very quickly. I think this is a market that may be turning around, but it's still not without risk. If I look at the Dow, it looks very similar, extremely similar. If I look at the NASDAQ actually looks a little bit better. It's got blue bars, so they're neutral bars. I could be going long NASDAQ stocks, which is nice because they've been getting killed. However, as I look at the NASDAQ, so make that smaller there. As I look at the NASDAQ, I see that it's still in a weekly sell signal. Monthly buy, high jumps low, bongo negative. And it did dip below this envelope, so it's no surprise that it moved back in. And then the Russell 2000, I don't have a quote there, but I bet I can get some charts, and you could see ran right up into this. These are painted, I think, these are some pivot moving averages. It ran up to the moving averages in reverse. And that's the problem in a downtrend. Are you going to run back into the middle and come back down? It's got a person buy signal, but it's weekly as a sell, so it's still a retracement in a downtrend and not necessarily indicative of a market that's turning around. I like to look at the dollar in real time, and I could see that right now we're not doing much today, but the dollar has shown some recent strength. It's really sideways, but if this is a Darvis box-like pattern, it's up near the high of the box. I can look at gold. If dollar's strong, then gold probably weakened, and it did late the week, but gold is very choppy. Look at the number of singles that are coming and going. Silver, a little weaker than gold, in a clear-cut sell signal. So I look at this market, and I see nothing that says to be bullish. I see maybe it's not as bearish as the pundits on TV are making, but do I see anything that makes me want to go out and buy this market? Except for the futures are still up, fair market value about 0.8% on the Dow and 0.8 on the NASDAQ, 0.5 on the Dow. I don't see anything here that's really favorable looking. Once I've got a good sense of the market, now I want to take a look at the sector. So let's take a look at sectors, and to do that, quit on that, sorry about that. I'm going to go into HGSI, my designer, and I am going to go first into Major Markets Plus, which is a Woodward Brown Group's full. I'm going to hit that plus, Major Markets Plus. I'm going to hit the warehouse view, and the warehouse view is going to pop up this warehouse, and I'm going to put the top-down view, which is what I use for my top-down analysis to look at where the money's been moving and what the strongest indexes are. And I want it to be on Major Markets Plus, not the ETFs. And we see that the things that don't go along with a bull market, bond prices, gold and dollar, volatility, silver, gas, utilities, and commodities are on the top, while the weakest things in the market are biotech and some of the other major indexes. So we've already looked at these, but very quickly, just for confirmation and showing how I use HGSI. I would typically not be looking at this chart for a short term, but I'm going to go into, how about just this one here? And I've always got an 8-day exponential, then green 17, blue 50, red 200. We already know what's going on. The market's pounding out sorry about that. The market is trying to pound out a bottom here. Right now it's holding. If I look at the Dow Jones Industrials, and again, we've already looked at, so I'm going quick, similar pattern. Now, I looked at futures before. These are the actual indexes, so there's small differences. If I look at the NASDAQ, that was the weak one on the week, and then the Russell 2000 using the IWM. So I look at these markets. I had a recent Phoenix, which is bearish on the market. My bongos are negative. And, will this 200-day hold? When it holds, it's a wonderful thing. When it doesn't hold, like it did in 2015 coming into 2016, when we had a pretty bearish market or bearish feeling market. And if we look at, for example, at the IWM, see if we were really a bearish market or not. If I go from the high up here, is that the high? Looks like the high to me. And I take it down here to the low. We were down about 27% on, let's do that again. From the high to the low, we were down 27% in 160 trading days. We reset the count of bull markets in my mind. We had a bear market between 2015 and 2016. All right, so the markets, I'm not going to go look at the gold and silver. Now I like to look at industry groups. I go to 07, I hit warehouse view. Now normally I would have looked at gold, silver, and the dollar and oil. We've already looked at least gold, silver, and the dollar, and we've looked at the VIX. I have 173 industry groups. I want to rank them on momentum, short-term momentum, to get a sense of where the money is flowing and how much this market is up versus down. We have 5 groups here. One of these is I'd ignore because all it has is a stock that is so manipulated in long fin that it's currently been frozen by the SEC and NASDAQ while they try to figure it out. I know a lot about this company. I've listened to the CEO a number of times. And just imagine, it went public here at about $5 a share. And on day 3, they bought a blockchain company that was owned by the CEO of Longfin. And then you look at the next day and buying a company that has no earnings and very little sales, the market traded up to a high of $142. If there wasn't a thing such as market manipulation, this stock is ridiculous. So saying that this whole group, this is the only stock in the group, I'm ignoring investment management. So there's only 4 groups that are positive: energy, metals, and apparel. Now what's interesting is you've got 2 energy stocks there that are positive, 2 energy groups, so not all groups are the same. And it's the refiners and perhaps the non-exploration that's exciting right now. If I look at 2-day to the downside, you see we have 86 groups. So we have 86 groups that are to the downside. That is not a bullish feel, but it may be so extreme that part of why we're seeing, maybe that's where we're going to see to drive the snapback in the indexes. If I look at the 5-day up, I have 33 groups. In the 5-day down, I have 63 groups. So both over a 1-week time frame and a 1-day time frame, the market is exhibiting some very bearish looking tendencies. So now let's go back and go back to 07. We're there. Let's go to 2-day force. And what I do as part of a top-down investor, I would right-click on integrated oils, change to index group, and let's take a look at them top-down based upon their combo rank. Now I'm going to show you something in a second. So the first three here, one of them is Suncor, and I believe, I don't know if this is a renewable energy. I thought maybe it's Sunoco, I don't know. But bottom line is it pays a 3% dividend, is broken above the moving averages. It was in an uptrend, it pulled back to support, had a pocket pivot in Kahuna. That looks interesting. Royal Dutch Shell, integrated oil, breaking out, pays a 4.9% dividend. And BP, an integrated oil, breaking out, pays a 5.7% dividend. Those are three stocks, big dividends, attractive stock patterns. So there's always something good in the market. That may be it. Now, if I change this to scaled, I may bring up different stocks because the DMA, 2DMA up is ranking stocks on the Force Index 2-day exponential moving averages. The things that go into this are price change, which is a small component except for direction, and volume. So the big volume stocks come to the top. I'm more concerned about volume change one day versus last. So my scale looks at the impact of volume. I notice Imperial and Sasol come up. So let's just take a look at them before we move on. So Imperial's pretty deep in the pattern, multiple kahunas and pocket pivots, although it had a negative one on Friday, pays a 1.8% dividend. Look at the earnings coming in. I think I still like the others better. And then here's Suncor, which is one I like. And Sasol, I tried to break out, doesn't look that exciting, so I would skip that one. But that's how I manipulate between the DME scale to the DEMA up. Right-click back. Specialty apparel, some of my favorites are here. Two that I own are the first two, Abercrombie & Fitch and Urban Outfitters. Abercrombie & Fitch broke out here in November. It's had a beautiful run since, breaking out to new highs. Is it getting extended? Well, as this green line gets close to the top of that, it is. I could go to TradeStation and I can quantify it better by looking here. We're at 100%. We're the highest extension that this stock has been in 200 bars. And I've got the red dots here suggesting that there's MACD divergence. So, and I'm out of the channel in the weekly. So ANF is probably a stock that I might want to take profits on or buy some puts. Its earnings per share growth is going to slow down, and it certainly looks like it's extended. So what I do is I put every stock, and I haven't updated this in ages. So I don't own most of these stocks anymore. I don't even know when I sold some of them. But what I do is I stick them in a window, and I'm able to flip through this on a larger, on a better resolution monitor. They all populate. And I have a chandelier stop on ANF. Right now it's bullish. If I break through this bottom, then I will put a stop at the low of that day. And if I trade below my stop, I'm out. So I'm using a chandelier to try and get me out closer to the top. The other one I own, which I think looks more attractive to buy tomorrow, is Urban Outfitters, based from December till now, and it's breaking out with pocket pivots, kahunas, and mobile breakout from a squeeze. Looking down the list, Chico's. I joked at our meeting, this is the company that my mother and unfortunately now my wife like to shop at, so it tells me I'm becoming older, but not my daughter. And then American Eagle Outfitters, another one I thought was an interesting chart. It looks like it wants to break out as well. So this is a very attractive group, good earnings per share growth coming in, and many of these pay a dividend. So maybe a bad market, but not for this. Now, what happens if I change to the scaled? Genesco and Taylor Brands come up. Let's just look at them very quickly. Don't know anything about Genesco, so we'll see what we learn something. Lower down the pattern than the others, but certainly in a nice uptrend since November. Had a doji on Friday that would worry me a bit. I don't like the earnings per share growth. I do like all those kahunas. And then Tailored Brands, I know, is one that looked great. It's already broken out, pays a 2.5% dividend. So this is how a top-down investor finds the best stocks in the market. Precious metals. So I mentioned that gold was weak. I like number 2 and number 3 here. I like the scaled here because there's some of these are smaller volume stocks. I like Kirkland as a small gold play. It's clearly an IPO. Had a pocket pivot kahuna in a squeeze. And then I liked AGI, which is Alamos Gold down in the pattern here, breaking above the 50 with a mobile breakout from a squeeze. Notice how this order changes when I change it to the regular 2DMA up. And here American Barracks comes to the top, and Newmont and Gold are coming up because they're higher value stocks. American Barracks, I like the mobile breakout from a squeeze in the pocket pivot. I don't like where it's starting from, way down here in a downtrend. So gold doesn't look that exciting, but I showed you some that look good. Another group that looked extremely exciting were refiners. And let's do it. And so we got Holly Frontier. We'll look at the first 4 because 3 of them look to me like things to buy. This is Holly Frontier Corp. What a beautiful uptrend, pullback deeper than the 50. Broke above the 50. This was the time to originally buy it. But now we got a bunch of pocket pivots, so a cup, handle, breakout. Everything's green up here, pays a 2.5% dividend, great earnings per share growth. This is Wolfpack territory. Delic breaking out, new highs, like this one, 1.9. This one scares me, CVRR. Love the pattern, pull back to the 50, kahunas, pocket pivot, ready to run out of a squeeze. 12.4% dividend. You have to do research on companies like this. Make sure it's not a limited by time, limited partnership that will liquidate over the next couple of years. So that's why it pays a high dividend. But love the pattern. And lastly, the Valero, another one that looks good. So another sort of a cup or saucer and potential breakout here, 3.4% dividend. Now contrast that with oil exploration, hold on a second, my bad, which is, I thought it was here somewhere. Let's force up, force down. Here's exploration production. And look at what happened with Diamondback Energy as an example of other stocks in the exploration category. They failed their breakouts, and they broke down hard, and they've gone from longs to shorts. So I think there's a message there that not everything is perfect in the energy patch. My technique of finding new longs works much better than my technique of top-down of finding new lows or new shorts. I went through this live. Not a whole lot came up in the first major groups. The market's been bad for so long. Most of these have fallen a lot already. We did see some things that looked interesting. And perhaps one of my favorite ones to short might be MasterCard. Here's a stock that's a big gorilla leader. It pounded against the 50-day moving average multiple times, ultimately broke through, and then failed at it on Friday and closed at the low, near the low of the day. That is an ISO failure, and based upon what David Elliott taught us, this may come down. Probably first stop would be about 160, and then could drop all the way down to that 200-day moving average. Now, another thing is I don't try and get in front of moving trucks, and this stock had amazing power, so I would be hesitant to put on a short tonight without seeing the market in the morning, and we may get another leg up. We may get a small bounce. We may sell off by 2 o'clock. Who knows? If the market is continuing down, I may be shorting MasterCard, but I got to see what the market is doing. I looked at a large number of stocks to the long and to the short side. Let me show you some highlights, and then I'm going to hang up and say goodnight. To the long side, this was my buy watch list. Let me just call out a few things that may not appear obvious to you. We'll rank them by force. No, I don't like that by scorecard. Balance, technical, and fundamentals. I am not interested in buying Micron right now. Micron is dead to me. But that said, I looked at this, I said, oh, it's could this be an island reversal tomorrow and a gap up at the 50? Still got some earnings coming in. I just wanted it on a watch list so I could watch it. We looked at Abercrombie, HollyFrontier, and Urban Outfitters. Tandem Diabetes Care is a Jesse Stein appearing stock, a stock that's been in a downtrend for some time, and now it's starting to move up. Doesn't look much there, but if I go into my screener in TradeStation and I look at DineEquity, not DineEquity, if I look at Tandem, as I was looking here, here's a stock that just had a high close doji the previous week and traded higher, so it executed. It's in a nice bull run. I agree with George Lea said you should have gotten a week ago. I think this one has more room to go, but it has doubled, so I may watch for a pullback. But it's now on my watch list. Fibria Cellulose, I don't know what they do. Don't really care. I guess it's a paper company. Great earnings per share growth. It's pulled back. It's right below the PSAR dot. I might be looking for some momentum and buy this when it goes through the PSAR dot if the market is supporting. Now, who would think that perhaps the stock of the night is Worldwide Wrestling Entertainment? Is this not an incredibly tight stock that pulled back to support, that just had two pocket pivots, a kahuna, a mobile breakout from a squeeze, and is ready to run again with good earnings per share growth? That's what I see, folks. And I really like the pattern. And if I look at this in TradeStation, I think it's going to be penalized that it's already, let's take a look. It didn't make my TradeStation list. All right. We didn't just die, did we? Yes, we did. Well, I'm not going to lose sleep over that. I can look at it right. Let's see if that brought it back up. All right. Suffice it to say, it's a beautiful pattern. It's bullish chandelier flipped, so it just got a new buy side there. Just flipped to bullish. It has percent B was 0.78, so it's near the upper part of its Bollinger Bands, but not too high. It showed both a pocket pivot 5 and 10 day this week and a daily bongo. And as I said, the chandelier just pushed bullish, and on Thursday it had a PPS buy signal. I think WWE looks extremely interesting, and I don't know what's going on with trade. There, all right, now we're better. All right, would you stop it already? There's some nuances with the new version, which is what I'm using here. But a PPS buy signal came in on Thursday. Still got a PPS weekly sell signal, but I bet that turns around this week as well. I like this Worldwide Wrestling or World Wrestling Entertainment, and I might put that on my watch list. In fact, I did. We looked at Valero. Floor and Decor, probably not a great buy point. The time to buy was back here. Pocket pivots, Kahuna's mobile breakout from a squeeze breaking above the 50. But I would put this in your mind as maybe the next Home Depot. I think this could be a multi-year bullish. Nice stores, expanding across the country. FND, probably certainly a new IBD America stock. We talked about Alamos Gold. And another one to think about, had an inside day on Friday, maybe a bearish harami. I can't, not the candlestick guru of some, but look at the earnings per share growth coming into the stock. Virtu Financial is a benefactor of some of the high frequency trading and the volume that's in the market right now. So we have now done a top-down analysis where I talked about why we are at a decision point. On some hands, I'm very bearish, but I see evidence that says maybe this is done going down and we're going to get a bounce. How far we bounce, I don't think anybody knows. We looked and saw some of the industry groups that we might want to be playing with right now. And those industry groups, if I go to, just to go back there to 07, hit the warehouse view, put the 2-day force on it. The groups that look most interesting to the long side: oils, integrated oils, specialty apparel, precious metals, and refiners. As I said, the futures were trading higher when we started. They are still higher. So maybe we'll get a bounce tomorrow, although it will change. There'll be tweets from the president before we get there. So on that note, I want to say good night. It was good seeing everybody this weekend in Orange County. It's always good to see old friends and to hang out with George Lea and others. You all have a great week. Be careful. I'm tending to sound a little bit more bullish perhaps than I intend to. I think this market can go either way. This minute, it feels like it's going to go up, but it's mixed signals, and we are at a point where if we break down at this level, we might expect to see us to have quite a bit more of a tumble. Good night, everybody. Be safe, and talk to you soon. Goodbye.